Ever since the meltdown late last year, that's the pal bear market, Garner's been bullish on the stock market. That's one of the reasons why I like her. She's been dead right. But all along, she has been using 3,000 as her target for the S&P. Well, here we are. Now Garner thinks it is time to get more cautious. I like a person who, when they hit the price target, doesn't just say, let's bump the price target. She rethinks. Why? She says there's a legitimate argument that much of the good news is already priced into the market. Look, we're already expecting multiple rate cuts from the Fed, right? We heard that again today with Steve Leisman's interview. We've got record unemployment. It's the longest economic expansion in U.S. history. And people also predict a certain amount of progress in negotiations with the Chinese, which we certainly didn't get today. And that's why Garner believes we're due for a breather, not a disaster, a breather. Let's go through our argument point by point. First, take a look at this chart, which shows the pattern of seasonality in the S&P 500 of the past 15 years. Well, the old sell in May and go away saw, that hasn't worked in ages. There are other seasonal trends with a lot more staying power. Garner notes that the S&P tends to peak in late July. Okay, this is historical patterns over a 15-year aggregate. Late July, and then trade down through late August. Sometimes that weakness spills over into September and October. In most years, it's followed by a terrific rally, although that's certainly not what happened in 2018 during the pal bear market. And that's the thing about betting on seasonal patterns. They're far from a sure thing, but they happen more often than they don't. Definitely something to keep in mind. The real crux of Garner's thesis, though, is sentiment. We often hear that this rally is hated, but is that true? She says the truth is it's only hated by the vocal minority of money managers who've missed it and desperately need stocks to go lower so they can catch up with the averages. Garner points out that the Consensus Bullish Index reports that over 60% of industry insiders they polled are bullish. Over 60. People like this market, which is not what we want to see. Remember, we want people who don't like it, who have to be converted to bulls, not bulls who get converted to bulls. They're already there. At the same time, take a look at the CNN Money, Fear, and Greed Index. I like this one. Measures put-to-call ratios, volatility, momentum, junk bond demand, give you a rough gauge of sentiment. On the one hand, the Fear and Greed Index is definitely in greedy territory, okay? On the other hand, though, it is less greedy than we've seen in previous rallies. You could argue this means that the market is more upside. Garner's more concerned with the trajectory here. She points out that the Fear and Greed Index has been making lower highs and lower lows, which suggests that the potential upside here is probably limited, at least for the time being. This chart did not make me as fearful as she seemed to indicate, but that's okay, because we're looking at an aggregate group. Like, what else? As Garner told us at the end of May, speculators may have gotten ahead of themselves with their predictions for multiple rate cuts this year. I like what I've been hearing from Fed Chief Jay Powell, said that at the top of the show, but if we only get one rate cut or even two, maybe there will be people disappointed. That's nuts, but there might be. How about earnings season? The fact is the averages have rallied coming into this earnings period, and she says that's rarely a good sign. Garner points out that the general pattern going into earnings is usual a counter-trend move. In other words, if the S&P pulls back into earnings, it's likely to bounce after we see the numbers. I've been telling you this myself. If it rallies in earnings, it's likely to dip on the actual results. That's one more reason Garner thinks the path of least resistance for this market might be lower, at least for the time being in the near term.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.